Okay, welcome to this trading example. In this particular screenshot, we're going to be covering an NQ short that appeared on multiple time frames, and it was up at the previous day's close area. A couple points to keep in mind for this trading example. The market environment we were in was definitely weak. We had been seeing a pullback or a correction in the overall broad markets for over a week at that point, and you'll see that on the screenshot. The opportunity or the trade setup appeared on multiple time frames, and that's obviously one of our major criteria for our trading setups is seeing the picture that we need to see occur on multiple time frames. It adds to the conviction to the trade. And then finally, we shorted after a big rally in price. So in a downtrend, the market is going to impulse move down and correct up. Impulse move down, correct up. We were simply waiting for that corrective move back up to an area where we saw price previously drop out of, looking for sellers to come back and join in on the overall down move, overall direction of the bigger market. And so those are the key points to keep in mind. And let's get right into the actual screenshot. So you can see on our chart we have a daily, a 60-minute, and a 15. Multiple time frames, again, is what we use and look for in our setups. We want to make sure we're seeing the right picture on different times. They need to have that confluence to really add to the conviction of the trade and give us the setup that we're looking for. So, like I said, weak market environment. You can see up in here in this red box highlighted that the market had broken out to new highs, couldn't sustain that breakout, and started to pull back. So the market started to move back. It broke some support in here, broke some support in here, and it kept moving down. But in this, you can see that there are corrective moves back up, pops back up, rallies back up before it continues its move down. And so we were simply looking for another rally back up in price so we can go ahead and take a short. And that's what we saw. And in this setup, like I said, we were looking for price to get back up to the previous day close area. Previous day close was 65.61. We identified an area, a swing high, if you will, within a 60-minute. We found this on the 15-minute. Both are within the daily. The daily is telling us which side of the market we want to be on for these bigger winning trades. You can obviously take trades, counter trend trades, but the bigger winners are going to be in the direction of their overall trend. And in this case, this was down. We go down to the 60-minute. We can see that prices fell out of this area, retraced, fell out of that area again, and then attempted to climb back up, got rejected right in here off of this 15-minute, which was above the 65.61, which was the previous close. So going into this picture a little bit deeper, on this 15-minute, we can see overnight, it was around 3 a.m. West Coast time, the market started to rally up, could not go any higher, based, and then dumped. This created a nice big move away from this price point above 65.60. It was above our previous day's close. There was an attempt to get up there. We couldn't even get up to this, and the market pulled back and created an even lower low. Once we held and we rallied back up to this area, this was another chance for us to take the market short. And that's what we did. Sellers came in and pushed prices down from this area, which was above the previous close. Previous close goes back here. The overnight rallied above that, couldn't stay above that level, and proceeded to fall back down towards the overnight lows. Once the regular trading hour session started, we attempted to rally back up to that area. Right below that previous close area, it failed and actually moved lower and set that lower low for the day. Once that low was tested again and held, naturally we expect the market to go back up and test the high. And at this point, it actually took out the regular trading hour high at the time, which was right around 65.60. So when prices took that high out, that pivot high, it came up into this area. That was the overnight high where the move actually was started from. In the corrective phase, impulse moved down a couple times, like I said, at this area. Couldn't even get into this. Took out the low, held, rallied back up towards the high, took out the regular trading hour high for the day, and that gave us our opportunity to short. Multiple time frames, starting with biggest to smallest. We are in a weak market environment, so we want to naturally look for shorts. Just because the market is moving down, you're going to get those snapbacks, those corrective phases up, those rallies up in price. We want to see a rally in price before we short. And so that's what we waited for. We found an area on multiple time frames, 60-minute, 15-minute, a price level that we liked. There was confluence in what we were looking at, the 60-minute and the 15-minute. And then we were looking for where's the open, where's the previous close, the overnight high, the overnight low, etc., etc. These are other things that we're looking for to add to the conviction of the trade. And then moving down to the 15-minute, we found the origin of the move down that happened overnight after we had a corrective move up. The impulse moved down into the regular trading hour open. Attempted to rally back up there. We could not. We failed. We dropped, set a new low. Once the low was held, we rallied back up towards the highs. We actually took out that swing high, that pivot high for the regular trading hour session, getting back up to the origin of the overnight move, that impulse move down, which was above the previous close level. Sellers came in and pushed this down. If you look back here, sellers came in and pushed this down. This was the previous close from the previous day. You can see that right in here off the daily. Was right in there. Overnight, attempted to climb back up into this candle. Got above the previous close a little bit, and that's where this is, right in here. And then you had another leg down before we had a retest back up into this spot. And then our targets were going to be simply the open and then the low for the day. Because we're in a weak market environment, we're trading in the overall direction of the major trend. We want to, be a little more lenient in our profit targets while still taking money off the table as the market makes it available to us. So we always take one off, at a 1-to-1. We're using multiple contracts, taking one off usually at 1-to-1, and then mechanically we set a 2-to-1 risk to reward, 3-to-1 risk to reward, and then base the other targets off of actual price levels and price points that we pay attention to. And so that's what we got in this case. We took some off here at 65.40, close to 6,500, and then we have a runner that we let go, usually a contract or multiple contracts, going for a final target. So hopefully this was helpful for you guys. This is just another example, another trade setup that we look for, this type of price structure, this type of price action. It may not always look the same, but these are the same things, the same criteria that we're using to find opportunities. Multiple time frames, knowing your market environment, waiting for a rally in price to short, waiting for the price to pull back before buying. These are just simple things that you can do to help increase the odds of success, increase the odds of your trades working out. And like I said, hopefully this was helpful. If you guys have any questions, please feel free to contact us. And if you do have the Derivatives Day Trader course and you need to review anything from this example, go back to sections 2 and 3. Other than that, we will see you on the next one.